The next interest rate cut is the focal point of the markets. What they are totally disregarding, though, is the expected rate of inflation, CPI, if you will, in the year 2026. And trust me when I say it will be skyrocketing. Quite quickly, it will be going up. As a buyer of last resort, the Federal Reserve and the Treasury have both established themselves. Then what will it accomplish? What it really means is that it will crash in an attempt to prevent the economy from collapsing. There is imminent danger of a full-scale buyer's strike on US debt, which might put the Fed in the most precarious position possible, that of buyer of last resort. According to past events, the dollar will not see a mild depreciation when that time comes. The crash will be intentional. The worst aspect? This play is nothing new to us. Due to hyperinflation, German funds were wiped out in a few months in 1923, rendering wages worthless. This time, however, the scope is worldwide, and the United States might be the ignition point. The same playbook is currently in use. There is, however, one refuge that stands out more than the others when fiat currency begins to burn. Valuable metals. Silver, which is underappreciated, ignored, and historically explosive, has the ability to accomplish what nearly no one thinks is possible. Gold will move first. Neither $30 nor $50 silver is what we are referring to here. An unprecedented parabolic climb in silver prices might put $1,000 within reach if the Federal Reserve triggers a currency crash to save the debt bubble. Whether or not this storm will hit is irrelevant. What matters is the timing. Are you prepared to deal with it when it arrives? Without a doubt. Listen, they'll tell you it's a sure thing. As a rule, the market rises. We will take out a loan to purchase further stock since we simply cannot stay out of it. Seriously, we're going to bankroll this thing. Wow, isn't it fantastic? Certainly, it is happening. However, this is something that appears at the very top of every bubble. The average person investing in equities has no idea what they're doing. Why? Reason being, they are rising and will continue to rise. I mentioned earlier that the valuation discrepancy has reached unprecedented levels. I am terrified. Truly, it is terrifying. That, basically, is our situation. Now, you brought up the topic of the 1920 to 1923 contrast with Germany. A considerable decline in the purchasing power of the Reichsmark occurred between the years 1918 to 1920, specifically between November 1918 and the end of the First World War. I suppose it's better to call it inflation, but that's just my opinion. The buying power of the Reichsmark has dropped significantly. Also, by halting all operations during COVID, this fits perfectly with the attack on our economies, if you will. To put it another way, from Germany's perspective, that was the same as 1918. We needed to get the economy back on its feet after it was utterly devastated. The result was an increase in prices. I believe this occurred in 2022 when inflation was at its highest. So, 102 years ago, in 1920, it reached its highest point. I find it intriguing that there was a boom after that. To top it all off, the mark had the best performance of any currency in the planet. The financial boom was, in a word, remarkable. In addition, from what I recall beginning in February 2020 to December 1921, the stock market increased by 300%. Everyone else was doing the same thing we are, investing into the market, becoming rich, partying, etc., just like you said. On the other hand, the working class wasn't doing nearly as well as they couldn't invest in the stock market to improve their situation. They were completely wrong. There was work, but not nearly enough to fairly distribute the rewards of a thriving economy from the top down. The stock market subsequently saw a decline on December 1st, 2020, 2022. No, the stock market reached its high in 2021. Finally, by December of that year, stagflation will be once again on the horizon, and it will seem hauntingly familiar. Both stimulus and tightening have failed to alleviate the economy's precarious twilight zone, which is characterized by increasing prices and sluggish development. One of the most explosive decades for precious metals in modern history occurred in the 1970s, when this exact combination of high inflation and poor growth produced unprecedented market activity. Silver, gold's untamed relative, surprised even seasoned investors, with gains that sent prices soaring. A similar scenario is playing out at this very moment. Inflation is expected to stay stubbornly above target in 2026, with projections ranging from 3.5% to 5%, while US GDP growth is already on the decline, estimated to shrink to only 1.8% in 2025. What this means is that buying power is continuing to decline, while wages and growth remain stagnant. People are feeling the pinch at home. Companies are having trouble making ends meet, and faith in the banking system is eroding. Silver stands out the most in this climate, which is why investors are flocking to hard assets. Have a look at the figures. At $31.50 per ounce, silver has already increased in value by 25% this year, and the demand for it is only going up. Investors are pouring historic amounts of money into exchange-traded funds. For example, ownership of silver ETFs worldwide increased by 12% in the second quarter of 2025 alone. The demand from industries has also not decreased. The market is unable to keep up with the demand for silver due to the rapid use of solar panels, electric vehicles, and other innovative technologies. Using metal as a hedge isn't optional. It's essential. Similar to the dramatic increase in silver prices from $1.50 to $50 in the 1970s, the groundwork is being laid for yet another historic run. What sets it apart? Today's stagflation is happening all across the world. Because of this, the possible gain for silver is even more spectacular. The phrase stagflationary actually makes me laugh. And it's not only because my uncle coined it during a House of Commons debate, I believe it was in the late 1960s, but for some reason I find it amusing. It wasn't exactly in this setting, but people are starting to notice. I mean, the reality is that production is tied to consumption, and this is something that economists, macroeconomists, and Keynesians fail to grasp. When people lose their jobs during a recession, their ability to contribute to the economy decreases. So, you know what? You cut output and consumers cut consumption. Things are bad. Thus, it operates in a quite linear fashion. Whether or not it is accurate is less significant than the fact that a decrease in the value of the currency, which is not surprising given that currencies are totally fiat, reduces their purchasing power. Therefore, as the value of a currency declines, the prices of goods and services will necessarily rise. Thus, stagflation is explained in this way. Even though it was a central principle of classical economics, the economists who rejected Say's rule didn't entirely disregard the lessons learned from past inflations. When we have hyperinflation, a situation of extremely high inflation, does the economy also experience a boom? Yes, it always comes with a falling economy, but prices still go up. So, how does one come to a situation where they are caught unawares by a crumbling economy and inflation? I mean, the two items are bound to complement each other. Since they are attempting to ignore Say's law, the Keynesians are totally mistaken. In my opinion, stagflation is actually a rather common occurrence. Well, that pretty much sums it up. Looking back at the last global stagflation, silver didn't merely increase in value, it plunged downward. The price of silver was a pitiful $1.50 per ounce in 1970. Its meteoric rise to roughly $50 by 1980 was one of the most memorable price increases in market history. There was a pattern to the surge. It was the inevitable result of a collapsing economy due to debt, inflation, and people losing faith in paper currency. In the present day, the similarities are striking. The Federal Reserve's 2% inflation target has been defied once again by stubborn inflation. Economic growth is deteriorating once again, and policymakers are stuck. In a move reminiscent of the 1970s, investors are subtly preparing for a storm. This time around, though, things are different. The financial system is more precarious than ever before, debt levels are unparalleled, and silver's demand extends well beyond the realm of jewelry and coinage. Fear of a financial collapse propelled silver prices higher in the 1970s. The same kind of panic is developing now, but an industrial supercycle is adding fuel to the fire. Nowadays, solar power, electric vehicles, and sophisticated electronics all rely on silver. This means that industrial demand, rather than consumer demand, is what keeps prices from falling too much. Silver now has a distinct edge over its previous state, thanks to its dual role. Silver doesn't merely circulate, as history demonstrates. The effect is similar to a slingshot. Initially trailing behind gold, it suddenly soars as faith in currency plummets. In today's money, the $50 peak from 1980 would be worth more than $180 after accounting for inflation. And that doesn't even take into consideration the current industrial shortage. If the 1970s marked silver's maturation, then the years to come may represent its pinnacle. Replays don't exist. An even more grandiose setting awaits this sequel. This is also the case in the United Kingdom. In my opinion, politicians always seem to mess things up when they get involved. An excellent illustration of that, in my opinion, is the housing market. Various forms of buying and other transactions are now subject to higher stamp duties in our nation. A cap gains tax on individual residences beyond a specific threshold has been the subject of much discussion. Everywhere you look in the market, including the proxy market, the government views it as a milk cart. Then, what are our next steps? You attempt to sell your house and go since you've come to the realization that landlords are truly despised by the Labour administration. It needs more immigration accommodations for whatever reason, yet it attempts to tax them to death. However, it is utterly terrified of having to depend on capitalists. This means that it hits them hard and taxes them again. The end consequence is a marketplace full of vendors but no customers. What you stated is essentially the situation in the United States right now, not to mention the government, which plans to construct 1.5 million homes, or whatever the final tally is, before this one comes to a close. To begin with, it's important to remember that building houses is a business endeavor, and the thought that these houses will materialize at the stroke of a magic wand, as everyone will accompany you, is appealing. Yes, the home builders and everyone else involved will claim to be on your side, but really, enough is enough. This needs to end immediately. Everything is going kaput. As of this writing, on September 10th, the equity market has not yet seized up, but it is about to reach a new high. I am astounded. Our official Silver News Daily Telegram has just gone up, so we'll be right back. A 10-ounce silver giveaway will be held to commence the proceedings. Exactly. Silver in the form of metal, not a voucher or digital credit. All things related to precious metals, including silver, market analysis, collection recommendations, and more, will now take place in this telegraph. The heart of the community beats there. The rules for winning the 10-ounce silver prize are as follows. You should subscribe to Silver News Daily on YouTube. Get the bell alerted and leave a comment on 3 different videos to enter the 10-ounce giveaway. Participate in the Telegram group and introduce yourself. We will select a lucky winner to have 10 ounces of silver sent to them immediately once we reach 500 active Telegram members. Get up and move about early. It was a familiar trajectory for every empire that eventually gave way to its own money. Countless deficits, careless monetary policies, and the gradual loss of faith in its currency. Right now, America is following suit. With no political will to control it, Washington's debt is approaching $2 trillion, or 7.5% of GDP in 2025. The Federal Reserve is cornered into a precarious situation where any action could have disastrous consequences because the government is not cutting spending but is instead increasing borrowing. This is the actual depreciation of the currency. Each dollar loses purchasing power as the money supply is expanded to cover the deficit. There is an eerie correlation as the dollar index has fallen 5% so far this year. Silver prices go up as the dollar goes down. In 2025, the correlation is measured at an astonishingly negative 0.85, indicating a very strong link. As a result, silver prices tend to rise in tandem with dollar declines. However, the focus here isn't merely on numerical data. It all comes down to faith. The decline in value of a currency quickly becomes a domino effect. Within a few short years, in the early 1920s, the German mark went from being one of the most trusted currencies in the world to completely collapsing. The dollar is displaying identical red flags today. Increasing debt, declining purchasing power, and a central bank with limited options. Furthermore, investors stop inquiring after that trust fades. They seek tangible assets. Because it is more than just a hedge, silver is in a special position. Plus, it's cheaper than gold. The fact that it is so easily accessible makes it an asset that nearly everyone can purchase when their currency loses value.